In the previous video, we learned that what is a financial risk. It is the possibility of losing money. Very simple. If you are doing some business, there is always a chance that you can lose money at any time. So in this world, there is no business which cannot lose money. So financial risk is always there when you are doing any business, or if you intend to do any business, you must keep in mind that there is always a financial risk. We also discuss six most common examples of financial risk. These are market risk, credit risk, liquidity risk, operational risk, legal risk, and reputational risk. Some people take five examples, some people take six examples, some people may take some more other examples of financial risk, but these are very common famous examples. In today's video, we are going to discuss one or two examples. The first example is the first question which we are addressing today is what is market risk? It is a risk that the business can be affected by the changes in the market in which it operates. Very simple. For example, for example, there may be a sudden hike in interest rate. So if your business is heavily dependent on borrowed money, whether it has been borrowed from banks or some financial institutions, it can heavily be affected if the interest rate is suddenly going upward. So there is always a risk in the market that if the interest rate is increased sharply and our business is heavily dependent on borrowed money, then we can lose money easily. So this is the first example. And there may be a sharp decline in the stocks prices. If the company is public limited company and its shares are traded on the stock exchange and people are buying its shares or selling its shares, in the market and there is a sudden decline in the stock prices, the investors heavily intend to sell the shares of the company, which can badly affect the financial stability of a company, where the company will start losing money very quickly. So there is always a risk that the share prices of the company can be declined sharply. And there may be increase in imported raw material. So if you are a manufacturing company and your most of the raw materials are imported from outside the company, and due to some political situation or due to some market factors, the prices of the imported raw material is increased. This will heavily affect your ability to compete in the market because of the high prices of the raw material. This will force you to increase your selling price, which will affect your customer base in the market, and there is always a chance that you will lose money. You will have to lose money in order to keep your customer. You need to lower these sale prices, which eventually cannot compete in the market. So there is always a chance that you can lose the market, you can lose the money. So this is another phenomena in the market. So there are some other factors in the market, in the environment in which any particular company operates, which can affect the company's ability to operate efficiently, which can cause the company lose money fairly quickly. Now, I tell you some tool. That tool is called one of the most widely used tools, the most widely tools used in market risk, in assessing the market risk, is called value at risk. It's called VAR, which enables firms to understand their overall risks and allocate capital more effectively or efficiently. Efficiently is the more appropriate word. Overall risk. This is one of the tools which is used to assess the market risk of any company. I will discuss this tool in detail in any following videos in which I will tell you what this tool is. So this is about a market risk. In simple words, you can say that any factor in the market in which any particular company is operating can affect the company in many ways. The consequence of each adverse factor can result in the company losing money. So it is the most widely risk which the companies try to assess at the very beginning and try to make measures to as avoid the market risk and reduce it to a manageable extent. One thing is sure that you cannot avoid market risk in total. There always will remain some market risk. All what you need is to manage it within a safe limit. So for this video, I have discussed market risk. In the coming videos, I will share the other examples with you.